Good morning, Money Stream Mortgage team. I wanted to take a quick second. This is going to be very fast and outline the differences between ARMs. Okay? So first off, you'll hear of a 6-month or a 1-year ARM. That's a true ARM. In other words, that's a loan that from the day one, every 12 months or every 6 months, it's going to adjust. Okay? You'll see it written as, a 6-month ARM, 1-year ARM, and then it's going to explain somewhere in the program description what is the index. An ARM rate is made up of two things, the index and the margin. The index is something like the LIBOR, the London Interbank Offered Rate, or it could be a treasury, and it's something that's variable, that can change. And there's the only requirement for an index is that the lender can't control it and the client can't control it. So it has to be something independent. And again, it's usually a financial measure like a bond price or the LIBOR rate, or you've heard of the prime rate. The prime rate is the Fed funds rate. It's the rate that the federal government, or the Federal Reserve rather, sets for lending money overnight to banks in America, as opposed to the LIBOR, which of course is in Europe. So an ARM can be a 6-month or a 12-month ARM. I mean, a 1-month ARM, 6-month ARM, or a 12-month ARM. It can be have an index and a margin. The margin is our profit. So if you say the index is the LIBOR, and let's just say the LIBOR is 2.5% today. So that's part of the rate. The margin is, think of it as our profit, or it's how much above the index we're going to put the rate. And those can be adjusted once as the loan is being written. But once the loan is done, that never ever changes for the life of the loan. And some things that can adjust a margin is program guidelines. So for example, it might say, listen, the margin is 3. But if the person's credit score, the borrower's credit score is above 720, it goes minus 1%, and it goes to 2. If it's a investment home as opposed to a primary residence, it goes back to 3 or plus 1. And so there will be a table of adjustments depending on the characteristics of the loan, characteristics of the borrower, and that's going to be what determines your start rate. And then subsequently on each adjustment period, your final rate is going to be, or your rate for that period is going to be determined by changes in the index. Okay? Now, we're going to call that quits for the moment, but remember, an adjustable rate mortgage interest rate has two components, an index, which can change, and a margin, which is fixed for the life of the loan.